Hey guys, Jacalyn here with Zenith Home Loans. Thank you for joining us for another one of our interview series. Today, I'm excited to introduce you to Kris Patel of the Unbiased Advisor. He is a financial advisor and planner. So thank you so much for joining us today. I'm excited to hear some of what you're going to tell us about today.
I appreciate the time, Jacalyn. Super excited to be here. Thanks for inviting me on.
Absolutely. So why don't you tell us just kind of a little bit about you and kind of how you got into this industry, and then we'll start from there.
Yeah, great. So I got into the industry about 20 years ago, actually. So I'm a seasoned veteran at this point, I think. I went up through the ranks, kind of. You could say, graduated college. I actually worked at the state of Indiana's pension plan, doing investments for the pension plan, and then had kind of decided, maybe the government world wasn't the ideal fit for me. So I joined a group of advisors, grinded my teeth on that and learned the chops of the business. And then in 2007, started my own firm, and I've been running with that ever since. Really, I always had an interest in finance and math and investments. And so I always wanted to be able to help other people kind of understand some of the lingos and put them in a better position, so to say, basically.
Okay, awesome. So what is a financial advisor, and do I actually need one?
Yeah, that's a great question. This question actually gets thrown around a lot between financial advisors themselves. I've met financial advisors that say everybody should have a financial advisor. I've met financial advisors that say only a certain demographic or group of people need it. I kind of fall in between. I akin it to gym membership and hiring a personal trainer, right? Like if you really want to put the time and effort into things, and you're kind of knowledgeable about finances, then you probably, and let's say your financial situation is pretty clean. You don't have a lot of moving parts. You don't own a business. You're not trying to pass on a bunch of wealth or stuff like that. Then you can probably figure things out on your own, because whenever you hire a financial advisor, you're going to pay the advisor something, right? And so the question then becomes is me hiring somebody worth it to me? Are they going to add any type of value? And going back to the gym example, everybody knows calories in, calories out, right? That's how we're healthy. Everybody knows I need to go work out, or I need to eat more cleanly, but obviously, a lot of people don't do that, right? So there's an accountability metric that a financial advisor can bring to the table, much like a personal trainer, right? Like the trainer is going to say, hey, we all know how to maybe do a bench press or a squat or whatever it is, but they are going to help you on some of the nuances and put a program together for you. But if you're the type of person that, can sit on YouTube, or I guess these days we're hearing a lot of TikTok stuff, right? And I'm not saying that's the best place to get your information, for sure. Not. But if you do enough research, if you want to spend time, if you enjoy it, then that's great. You probably, paying a financial advisor might not be the best thing. It might be a good idea just to see a financial advisor and maybe get a lay of the land, so to say, and say, am I doing the right things? And if you are, then off you go, and you're going to save some expense, right? But again, if things are complicated, I don't know, let's say, I have a knee injury, right? So I can't do squats properly. So instead of trying to do squats and busting up my knee, I might go see a personal trainer and say, how do I work around this, right? So that's kind of where I fall in line with, do you need a financial advisor or not? What a financial advisor is, when I first got into the business, the notion was that we had this secret box, so to say, right? Like, hey, give us your money and we're going to make you more money than you can make on your own.
Right.
What's happened in the industry, though, is, and along with the proliferation of information, the internet, we can see things on the internet, we can research things on the internet. There's no black box, so to say, right? There's nothing that I'm going to tell you that you probably can't dig up on the internet, really. Now, is that thing the right thing for you? That then comes down to the nuances of your particular situation, right? So advisors will add value in those types of situations where you do have nuances, or you do want to maximize your taxes, or at least the taxes that you're paying, or you want to maximize the amount of wealth you're going to transfer over to the next generation, or I have a business, I want to make sure I'm properly accounting for the cash flows and things of that nature, right?
Mhm.
Nowadays, really the value that an advisor is going to add to a person's situation is not only on some of those nuances that we talked about, but also in behavior. What we've come to understand and learn in finance is like investing actually isn't that hard. I know Wall Street tries to make it out like it's this like thing that nobody really understands except for the super smart people. But that's not really it. What ends up happening is behaviorally people do the wrong things at the wrong times, basically.
Okay.
Everybody kind of knows the golden rule is buy low and sell high. What we end up seeing is people do the exact opposite. They will wait for the markets to do well or a stock to do well, and they'll go in and buy it. And then eventually that stock or the market will start to roll over and come down. And then they have this emotional component known as loss aversion where they can't handle losing money, and then you sell out, right? So you've kind of done the exact reverse of what you're supposed to do, where you buy low, sell high. What we tend to see is people wait for the market to go up or something does really well. Hey, I want to buy that mutual fund or that ETF because it's done really well over the last 2 or 3 years. But that doesn't mean it's going to do well going forward. And in investing, eventually some of those things roll over. In fact, there's no reward without risk, right?
Mm-hmm.
So you have to take some type of risk. That risk is you're going to lose some money at some point in time in the future.
Right.
And what people do is they'll react and they'll sell out at the wrong time. And they'll chase returns, so to say. So an advisor now has also not only help with nuances of your financial plan, like should I allocate to a 401k or an IRA or whatever it is, but more importantly, I think, and that's kind of why we named our business the Unbiased Advisor. We're trying to help you with some of these ingrained biases that everybody has. They're known biases that people have. And we're going to be there as a sounding board to say, hey, wait a minute, maybe this is not the right time to be buying in to this investment or this product. Or conversely, hey, this is not the best time to sell, right? Because you're kind of locking in a loss or something like that.
Right.
I think, again, most people understand that, like, logically, that's what we want to do. And a lot of people think they're logical, and we all tend to hope we're logical. But emotions come into play when you're dealing with something like wealth, right? Like your money for retirement. If you're 2 years out from retirement, this year is a great example, to be honest with you, because this year, like, nothing has worked. The investment world is in a lot of pain, so to say. And people going or coming close to retirement might make irrational moves because of emotions, not because of logic, so to say, So when I sit down with clients, I, kind of evaluate, what they're doing, what type of experience they have. We have clients that are very smart, but they just don't want to deal with it, right? And they just like dump it to us.
Right.
We also have clients that just don't know, right? Like, hey, I don't want to spend the time researching which stocks or mutual funds or ETFs to buy. And so they're coming to us for that advice, and we can provide that advice. But in the long run, what's really going to help you is us being the sounding board and putting you in the right position, or at least setting up your plan to kind of fulfill your wishes, essentially.
Right.
And that's where a financial advisor comes into play, really.
Okay. Awesome. Yeah. And so how do I pick the best one for me? Like, is there a good rule of thumb of what I should be looking for or questions I should be asking before I select an advisor?
Yeah. So it's kind of, unfortunately, really anybody can call themselves a financial advisor. It's kind of the wild, wild west as far as like designations are concerned. So I can literally sit for like a 2-hour exam and get a cert and call myself a financial advisor, basically.
Okay.
So there is a big issue and problem in the industry with that. Now the government and the regulatory bodies are trying to kind of deal with this, and so they've come up with some certifications that they consider more in depth. The biggest one is known as a CFP. It's a certified financial planner. There's a training program you go through. You get certified after taking, exams and whatnot. So those guys tend to be obviously fairly knowledgeable of the things that should be done when dealing with clients. I have what's known as a CFA. It's a chartered financial analyst. same kind of program. It's a 3-year program. You have to get certified, et cetera, et cetera. But when it comes down to it, usually you want to look for somebody that's a fiduciary, right? So a fiduciary is going to be someone that falls on the rules of the fiduciary law, which is, we have to put the client's interests ahead of our interests, right? Now, there's obviously cracks in the system and stuff like that. So you want to start out with talking with a fiduciary, and then you want to meet with that person and kind of get how they invest. Like, what is their philosophy? What is, how long have they been in the business? What are their investment concepts? How do they believe people should manage taxes and things of that nature? So it really becomes like a relationship type of thing, right? It'd be best if you had somebody else that kind of referred you in or introduced you to an advisor that they've been working with for a long point in time. And kind of the red flag that I would tell you to kind of look out for is, if the advisor is going to promise you any type of return or magic, so to say, right? Like, that's where you're going to get into trouble, because there is no magic, so to say, and there is no like guaranteed rate of return that I'm going to be able to promise you, because it's all kind of at the will of what's happening in the markets at that point. With like housing, right? Like, we always seem housing is going to go up, but there are points in time where it doesn't just go straight up. Now, so if I'm a realtor and saying, hey, go ahead and buy this house because it's going to make 7% over the next year and year after year, that's kind of a red flag with an advisor, because there's no way we can really determine ahead of time what's going to happen in the market.
With the fiduciary piece, are there certain advisors that aren't fiduciaries and will advertise that?
Well, you can't advertise it, so they would be in a lot of trouble if they advertised that they were fiduciaries. But to your point, again, this is kind of hard. So there are documents that we have to provide clients that basically spell out that we are fiduciaries, right? So if you go into an advisor and they're not handing you these documents, they're known as ADVs, is the technical term, but it's a document that says, hey, look, basically we're trying to invest your money for your interest, not our interest, right? We're going to disclose all our fees. We're going to be upfront about, the performance and the risks of this investment. But that's, I'm going to be careful as well. But that's not to say if an advisor is not a fiduciary, that they're, you should throw them by the wayside. If you have a good relationship with somebody, and again, if you're talking to them, you understand their investment philosophy, they have a good knowledgeable background, they either have some type of certificate, whether it's a CFP or CFA, or some other, there's so many designations at this point. It's like alphabet soup, really. And you get along with them and you understand. And again, they're not over promising you, right? Like, they're not saying we're going to get you 20% return and no risk, right? I don't want to throw those advisors under the bus and say, don't ever work with them, because there are good advisors out there that don't necessarily operate under the fiduciary umbrella, but a good place to start is the fiduciary umbrella, right? Like, just to make sure that, look, these guys are trying to do what's in my best interest, as opposed to looking at their own revenue stream or something like that, basically.
Okay. Is there a minimum amount of money that I should have access to as a consumer before I go and seek out the services of an advisor? Like, is there a minimum that I need to have in order to invest with someone like you?
Yeah, it's a great question. My philosophy is a little bit different, and the industry has kind of morphed into, previously, like when I got into the industry, like the big advisors would be like, look, Jacalyn, if you want to come and even talk or sit down with me, you need to have 150, 200,000, 250, whatever the number is, right? But the industry has really done a good job of now saying, look, even if you don't have any money, we're just going to charge you a flat fee, so to say. So you pay us this flat fee, and it varies across, from 500, I've seen $10,000, right? Like, it varies across the spectrum. And for that $500, we'll write up a plan for you, and then you can go ahead and implement it yourself, right? Other advisors will say, we need to have some type of minimum for us to like write up a plan for you and talk you through all the nuances of your situation. Now, whether you invest that with them or not, that's kind of up to you at that point. But there's no necessary like golden level, so to say. Like for me personally, I always try and say like, look, again, it goes back to that value proposition, right? Like if you have like $10,000 and you're a young person, you're you're a W-2 employee, you don't have a whole lot of tax issues to worry about, you don't even have kids, like I can manage the $10,000 for you, but you're going to pay me a fee to do that. And is it really worth it for you? And my answer is no, typically, right? Because again, I'm not going to provide some type of magical investment that's going to do better than you going to like Vanguard or Fidelity or one of these other shops and doing it. So if I can kind of eliminate that fee for you that I'm going to charge you, you're better off just doing it yourself. Now we'll kind of guide you or push you along and say, maybe you want to do this or that. We won't get too deep into the woods with you, unless you're doing like a flat fee. And that's where we'll like really specify, hey, this is what you need to do. These are the check boxes you need to mark off, et cetera, et cetera. But there is no hard number, because again, it goes back to like the whole, personal trainer thing, right? Like if you've been working out all your life, and you go and say, okay, well, maybe I do need a personal trainer. Well, how much extra knowledge is that personal trainer going to give you? I mean, there is going to be some, but then the question is like, how much is he charging me? And is it going to be worth my my expense to take that on, right? Like he's going to add a whole bunch of value basically to my current situation, right? So there's no like across the board, there's no hard line. Again, some advisors will say that, yeah, you need 250,000 to come and talk with me. Other advisors say, look, we won't even manage the assets. We'll just write you a financial plan, right? And to write up a financial plan and give you a map, so to say, to get you to where you want to go, it's going to cost a flat fee or something of that nature.
Okay.
Right?
Okay. So there's no minimum necessarily, but there's going to be different services you'll have access to depending on what kind of liquidity you have access to, it sounds like.
Yes, that's correct. And again, it comes down to the value that you're going to receive, because you're going to pay someone, to do all of this for you.
Yeah.
Again, some people are like, I have no idea. I don't want to spend the time and resources to figure it out. I'm willing to pay that flat fee, or I'm willing for you to manage the 10 grand for me, basically, because I don't want to deal with it. Right.
Okay.
But I always try and express to the client, look, you have 10,000, I can manage it for you. It's going to cost XYZ, but you'd probably be just as better off going to Vanguard and putting it into, ABC fund or ETF or whatever it is. And you'll roughly end up at the same spot, basically.
Okay. Okay.
Yeah.
Good. Cool. You've kind of already answered this, but what are some common mistakes that you see people make when it comes to investing? Is there anything, because we've touched on doing the transverse of buy low and sell high, that people are doing the opposite of that. Is there any other common mistakes that you see people make?
Yeah. So like it really comes down to behavior, right? Like again, the buy low, sell high thing we tend to see, these are biases again that are ingrained in us. We have this bias that was discovered by Danny Kahneman and Amos Tversky back in the 70s, known as loss aversion. Loss aversion is like our tendency to feel more pain and losses than pleasure and gains, basically. So for example, if I gave you $10, you would have some unit of happiness, but if you lost that $10, you'll have more units of displeasure in losing the $10 than in gaining the $10, basically. Okay. Right. So this is the notion of loss aversion. And this is what really comes into play when the markets are going down. Like you've gained this big amount of money, but now you start to lose it. And now your emotions are like, ooh, I can't tolerate these losses any longer. And I need to just cut it out, basically. Right. Okay. Another bias we deal with is known as recency bias. So recency bias is our brain's tendency to essentially take what has happened in the recent past and like forecast that going forward, basically. And the example I use here is like the roulette table. I don't know if you go to the casino, but behind every roulette table, there's like a board behind it that shows like the last number was X, previous number was 12, blah, 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 black, red, whatever it is. And the casinos put that up there because they know our brains will like kind of gravitate to that and try and seek out a pattern that's happening with the roulette table. even though the spin is like totally independent, that little ball that's on that roulette table has no idea what's on that board, right?
Right.
But our brains automatically kind of take what has happened in the recent past and then kind of forecast that into the future. So with investing, it goes back to that like notion I was telling you. Like one of the things we ask clients when we look at their 401k allocations or whatever investments they have is like, how did you determine that this is where you wanted to park your money? And the answer typically is always, well, when I looked at it, that was the best performing fund, right? Like that had done the best over the previous most recent period. And that's where they put the money in. So
Okay.
the issue there is like, again, there's no reward without risk. So you are buying in at a higher level, so to say, than had you bought that fund or ETF 3 years ago. So you want to you don't want to just, you want to allocate your portfolio. You want to build a portfolio that's going to kind of fit what you're trying to achieve, both on a return basis, but more importantly on a risk basis, because at some point in time, the portfolio is going to go down, and you want to keep the portfolio within some type of guardrail that you're not going to freak out. That loss aversion that we have is not going to like flip on, and you're going to like call me up and be like, hey, I need out, basically, right?
Yeah.
So that's one of the things that we see is, again, it kind of plays on these biases that we all have. The other thing I would mention is, with the proliferation of TikTok and Facebook and all that stuff, is just getting information from the internet and like putting that into action, right? Like just because somebody says on TikTok that has 300,000 followers does not necessarily mean that they actually know what's going on, because in the short run, the markets are kind of run by psychology. Really, it's like, are we happy today? Yes, let's buy, the market. Are we sad today? Let's sell the market, right? Like the reason the markets haven't been doing well this year is because everybody thinks there's a recession that's going to happen, basically, or we're already in a recession, basically, right? So people are like, well, look, I want to get out in front of it. I want to sell out. I don't want to be part of that, because we all know what happens with markets and recessions type of thing.
Right.
But at the end of the day, if you have a long horizon, a good horizon, you just want to stay invested, basically. And people try and time the market. We always say it's not about timing the market, it's about time in the market, right? Because you get this compounding effect that happens way into the future, basically. Because nobody has this black, the 8 ball, so to say, or a crystal ball that tells them, hey, like, this is the bottom of the market, or this is the top of the market. Nobody just has that. And unfortunately, with all the information that's out there, people profess that they have, the crystal ball or whatever it is. And then you make kind of these decisions based on what they pulled out of a hat, basically, in the morning. Yeah.
There's been some interesting stuff in social media lately, hasn't there?
Well, yeah, because the markets aren't doing well. And the investments, the other thing I tell clients is, like, again, everybody kind of looks for this secret sauce, so to say, or this black box. And there are premises or like investment theory, so to say, that work during different economic regimes, but there's nothing out there that works over every type of economic regime that's out there, right? So I try and stress to my clients, look, we have these positions to do well during these types of economic regimes. They probably won't do so well during these types of economic regimes, but we don't know what economic regime we're ever going into. Like, nobody, again, has clarity on what is inflation going to be. I mean, the Federal Reserve, last year was saying inflation would be down by this year, and still we're at like 8-9%, right? Smartest guys in the room, so to say, got it wrong, right? So, what's the guy that's, the Monday morning quarterback that's online trying to figure stuff out? Like, it gets a little dicey when you're trying to time the market, because nobody knows what's going to happen in the future, basically.
Okay. Good points. What is one thing about investing that you wish more people knew or believed?
So first, we hear a lot about like the stock market. Some people akin it to like the casino, right? Like, I'm going to bet on Amazon to do well going forward, but it's kind of, some people view it as a bet. when you really look at it, the stock, when you buy a stock, you're buying ownership in a company, basically. So if you go and buy Amazon stock, you're actually an owner in Amazon. And as an owner of Amazon, you are entitled to the profits of that company. Now, if I buy one share and Jeff Bezos owns, 50 billion shares, he's going to have a lot more say on how to deal with the profits than I do, right? Like I can't go and say, but at the end of the day, I'm buying a share in a company, basically, right?
Mm-hmm.
And we get into these markets where the markets come down and everybody kind of freaks out. And my first thing that I usually say is like, look, tomorrow, are you going to wake up and brush your teeth? Well, yeah, probably. Well, what are you going to brush your teeth with? Crest toothpaste. Well, guess what? Crest is owned by Procter and Gamble. Procter and Gamble is listed on the stock market, right?
Yeah.
So I always say, like, as long as you believe people are going to buy stuff, the market will work in the long run, because these are all just companies that are trying to generate a profit for their owners, right?
Mm-hmm.
So, and it's proven over time, like the market goes up over time. Now you could have 2 years of bad market performance, or 3 years, or, the 2000s was, we had 10 years of like basically zero growth. But the fact of the matter is you're buying ownership in a company, and those companies are trying to make a profit for you. So as long as you believe that people, excuse me, are going to wake up and, brush their teeth, eat General Mills cereal, buy milk from Dean's, get in there Ford, Mustang, all this stuff that is in our society, right? Like our society is consumption-based society. I was telling my admin assistant the other day, it's like, for whatever reason here in the West, like we are just like keeping up with the Joneses. It's like the mentality, right? Like we always want a bigger house. You probably know this, like you can look at charts of like the size of houses, right? Like it's just like straight up, right? Like people want bigger and bigger houses. And that might change here and there for like certain spurts, but in general, we always want bigger is better. We want a fancier car. We want, nicer clothes, whatever it is. That's the mentality that's here. And in order to achieve that, you have to go buy that stuff, and you're buying that stuff from companies, and typically those companies are listed on the market, right? So I guess a long story short, it's like the market will work in the long run as long as people continue to buy stuff. If you get into a situation where you think, our like cultural mentality has changed and we're not going to be consumers anymore, we don't want to, keep up with the Kardashians or the Joneses or whatever, then yes, you could probably make an argument that, you don't want to own businesses at that point, right? Because people buy, they're just going to save money. But I don't ever see that. I've never seen that happen in my lifetime. Now I'm only 40 plus years old. So, but historically speaking, that's never happened, right? Everybody's always tried to buy bigger and better things. They want better stuff for their kids. I got 2 children, they're buying Nike shoes. Like when I was a kid, we'd go to Walmart and get, whatever, $8 shoes or whatever it was. Right. So it's just this mentality. And I think people often construe the market or stocks in general as like these gambling tickets or lottery tickets, but it's really an ownership in a company. And what you're betting on is that company is going to be around and they're going to sell stuff, well into the future, basically.
Yeah. Okay. Nope. That's good points. Everybody's always trying to one up themselves or their neighbor or whatever.
Yeah. I mean, it's always like that, right? Morgan Housel, he's a finance writer. He talks about the man in the car theory. So when he was like growing up, he was a valet basically, right? And he would at a fancy restaurant, and he would always valet these super expensive cars and exotic cars or whatever it is. And one of the things he points out is like when he received the key for the car, like he didn't really care about the person that was driving the car, right? He just cared about the car. Like he would go into the car and be like, oh, this is cool, blah, blah, blah. But people buy that car because they think people are going to look at them, not necessarily the car, so to say, right? But it's like a vanity thing, right? Like I'm going to buy this super cool car and people are going to think I'm cool. But what he was pointing out was like, nobody cares about you, bro. Like they just care about the car. They just care about the car. Right? And I thought that was very, intuitive because like at the end of the day, we might say, Janice, got a mansion, but we want to go see the mansion to see the mansion. Typically, we don't, Janice is still our friend, but we might be jealous or whatever it is. But it's this notion that we, for whatever reason, we're hardwired to like want better stuff, or more stuff. If you think about it, like from an evolutionary trait, it makes sense that we would want more stuff. Like when you were living on the savannah, you want to try and collect as much food as you could because there could be a drought, right? Or you want the best shelter possible because if there's a flood, you want to be able to withstand it or whatever it is, right? Like that's just ingrained in us in thousands and thousands and thousands of years of progression, basically.
Yeah. Okay. Yeah. What is the difference between an IRA, a 401k, all those different kinds of accounts that everybody puts money in? But I feel like most of us don't know what they are.
Yeah. So really those titles are like IRS titles, basically. So they tell the IRS, like whatever money is in this, I call them umbrella. So it's basically an umbrella that tells the IRS, like, we're going to tax this money a certain way, basically.
Okay.
So you could have a 401k, which is typically almost exclusively offered through an employer, right? Okay. So that's a code in the IRS code called the 401k code, but basically says, hey, employers, set this up. Your employees can put money into the account. We won't tax it as it grows. And then, when you pull money out, we'll tax it at the end. That's a traditional 401k, but your employees putting money in, they get to write off however much they put into the 401k. Okay. But I don't want to confuse the subject. Really, these things are just telling the IRS, like, look, this is how we're going to tax the money, basically. Right. Okay. Now what you can put in there, like you can put different things in there. So most 401ks have like mutual funds or ETFs in there. IRAs, you can do like individual stocks typically, or 401k or mutual funds, ETFs. You could put gold in there. You could do like different things, basically, right? But that's just telling the IRS, hey, look, this pot of money, so to say, is either not going to be taxed this year, and based on whether it's a Roth IRA or an IRA, a Roth 401k or a 401k, like the taxation of the money that goes in will happen at either the front end or the back end, basically.
Okay. Yeah. Okay. And so why, and I don't know if it's true on IRAs and but on 401ks, why is there a limit on how much I can put into that account each year?
Yeah. So with a traditional 401k, like whatever money I put in there is deducted from my taxable income in the given year, right? So let's just use an example. I make 100 grand. I put in 20 grand into the 401k, right? So now when I do my taxes at the end of the year, the government's only going to tax me on $80,000 of income. Okay. So that money I put in there, like, wasn't taxed. Now that money then is also going to grow tax-free. So I don't pay taxes on any of the growth. But then in retirement, when I pull that money out, the government will tax me at that point at income tax. Okay. So the reason the CAC comes in is, like, if I made 100 grand, I could put all 100 grand in there and then like tell the government I didn't make any money, right? Okay. And the tax receipts would go down, and the government doesn't like that. Obviously, that's how they make their money, right? So they're saying, look, we want to incentivize you to save for retirement, and these are great programs. Yes, do it, right? But we don't want people like scapegoating the whole system, right? Like, you just dumping in a bunch of money, and now there's no taxable income, so to say, for the government to collect taxes on. So that's where the limits come in. They always kind of like tweaking with it every 4 or 5 years and stuff like that. But in general, that's the reason there's a limit. They just don't want, big executives just dumping in a bunch of money and then don't get any tax revenue on people.
Totally makes sense.
Yeah.
I did not know that. So I was like, oh yeah, I guess that does make sense.
Yeah. That's that. They're just trying to avoid, again,
not making any money
in the system.
Yeah. Okay. What is the best way to get started with saving for retirement?
Ooh, well, the first step is starting, right? Yeah. Like recognizing that, hey, I need to do something, right? We typically will tell people that are starting out, the best way to go about it is like set it up on like a monthly type of contribution to an IRA, 401k, whatever it is. So that way it's just like, it's an automated thing. Again, this whole thing with like biases, like we're really bad as humans if we have to do something to initiate some type of action, right? Like going to the gym, like I have to physically get in my car and drive to the gym, right? And once I'm there, I'm okay. But like I'm sitting in the car thinking, oh, do I really want to go out? So as much as you can automate things, the better off you're going to be in the long run. So the first recommendation is like, look, if you're just starting out, I need to automate the system, so to say, right?
Okay.
The second thing then is kind of determining, well, hey, where do I put the money? Well, I guess before that, you want to figure out how much money you can put away on a monthly basis, right? So this is a budgeting project. You might have to sit down for 2 or 3 months and kind of figure out, hey, this is how much spare money I have. And I have this amount of leakage that's happening. Maybe I can stop some flows and I can save $100 a month, right? So the first step is figuring out how much you can save. And then the next step is like, what's going to be the most ideal place to save it, right? Like, do I want to put it in a 401k? Do I want to put it in an IRA, or do I want to do both, or whatever it is? That's where you have to do a little bit of sleuthing, right? Like you're going to have to like kind of figure out, you could go on the internet and say, okay, well, IRA versus 401k, which one's going to give me the best bang for the buck? Typically, the 401k is like usually where we tell people to first start out at. And the reason that is 401ks typically give you some type of match. So the company will say, hey, Jacalyn, if you put in 5%, we're going to match 50 cents on the dollar up to that 5%, right?
Okay.
That's like free money that you're receiving. Okay. So if I didn't put the money in the 401k and I just put it in an IRA because I did some sleuthing and I think this is the best thing, I'm losing out on that money that the company is going to give me, right?
Okay.
Retirement, right? So we usually we first look at the 401k, make sure that the company is matching, and then we will say, okay, look, this is an amount that you should start here. And then if you have spare capacity, then we might go somewhere else with it. But in general, the 401k will typically essentially give you free money. I hate to say it's free. The company is paying you money in there. And the expenses are usually very, very low because 401ks are heavily regulated by the regulatory agencies. So they're really like cognizant, and companies these days have come to notice because they've had liability issues. Like workers have sued companies saying, look, you're offering us expensive investments in the 401k. And the government's usually sided with the employees in that case, right? So when you invest money in a 401k, you can usually get investments at a cheaper rate because A, they've had liability issues, but B, they're aggregating everybody's investments in this pool, right? So by nature, the expenses are going to be lower because you're kind of buying in bulk, so to say, right? Whereas if I go by myself, it's just me, right? Like trying to buy something. And so the company on the other end might charge a higher fee or whatever it is, right? So the first step, I would say, like, A, determine, I want to start saving. B, how much can I save? 3, I want to automate it as much as possible. And then 4, again, this is generally the case. I don't want to say like a blanket statement. This is the issue with TikTokers and YouTubers, is like they make these blanket statements, and that's not always true. But in general, yes, like the 401k, they're going to match you money. They're going to give you money as long as the investments are, somewhat sound. Again, they've had liability issues there. So they usually have pretty sound investments that you can invest in. That's where I would kind of start at, basically.
Okay. Yeah. And then any tips for somebody who's thinking about investing in stocks? Or does that kind of falls in line with some of your notes on investing in retirement in general?
Yeah, look, I have the CFA designation. Like my designation is actually stock analysis, right?
Okay.
And what I've kind of come to learn over the last 20 years is like, it takes a lot of work to really, get nitty gritty to figure out which stock you want to own, basically, right? So we generally stay away from giving individual stock picks, basically, right?
Okay.
And the reason that is like, we've looked at all the research, we've looked at all the literature. It is very, very, very hard to find the needle in the haystack, right?
Yeah.
After the fact, in hindsight, we can say, yeah, I should have owned Amazon, right? Like I should have bought Amazon when it IPO'd or came onto the market, and I would be a gazillionaire. That's great. Well, if you look at Amazon's stock price in its first 10 years, it lost 50%, like 4 or 5 times. At one point, it had lost 90% of its value, right? Like, so that's then now where the biases come into play. Like, I always tell clients, you put 100 grand into this thing, it goes down to 10 grand, right? You put 100 grand in, it goes down to 10 grand. Are you going to sit there and like, hang out and wait for it to go back up? Like, unless you're Jeff Bezos, you have no incentives to stick around, right? Like, you think at this point, the company is going to go bankrupt and I'm going to lose the 10 grand that I have, right? And that's even if you make it to that level. Like, I lose 20 grand. Okay. Maybe I need to reevaluate, but I think it's still a good company. I lose another 20 grand. Yeah, I'm a stupid guy, right? Like, I should have never invested this thing. I'm going to pull out at that point because I can't take any more pain, right? So when clients, a lot of clients always ask me like, hey, what stock do you like? And I'm like, look, there's this report called SPIVA that S&P Standard & Poor's puts out every 6 months. And what they do is they look at like all the professional money managers and they evaluate them against an index. So like, just like in this case, the S&P 500 index typically. So they'll say like, well, how many of these professional managers have beat like just a buy and hold, like these 500 stocks basically, right? And what they find year after year after year is like only 20% of the professional guys, 20 to 50% of the professional guys are actually beating this like haystack, right? These guys are paid to find the needles in the haystack. That's their full-time job, right? Like, that's what they wake up to do. They have all these certs, BlackRock, Vanguard, they have PhDs on staff. Like, this is their, bread and butter. And when you look at the data at the end of the day, they have a tough time beating like an S&P 500 fund. So you could just go buy a plain vanilla, the haystack, so to say, and you'll be okay in the long run. So, I'm like, look, I'm just a guy with 2 computer screens, living in Broomfield. Like, I don't even have anywhere near the firepower these professional managers have.
Yeah.
They have a hard time picking stocks, right?
Okay.
Like, so I'm like,
gambling.
why am I messing with trying to find the needle, right? Just buy the haystack.
Yeah.
And the haystack will continue to grow because of that whole keeping up with the Joneses thing, right? In the long, like, money is going to accumulate in that haystack because people are going to be spending time on Facebook or buying Crust toothpaste or whatever it is.
Right.
I don't need to mess around with trying to find the next Amazon, because it would be great if we could, but for every Amazon there were 99 other stocks that failed basically. Yeah. Right. And, for the people that say, I have a great track record, or, the question then also becomes like, how much of it is luck and how much of it is skill? Like, I talk with day traders a lot, and when the market's going up, like, they're all doing great, but that's kind of like, the tide rises all boats type of thing, right? But then when the markets are going down, they kind of get into trouble because like they don't, in general, the market as the haystack is shrinking, right? Like, so regardless of you having the needle in the haystack, the overall haystack is shrinking, right? Right. So individual stocks, I'm usually not the right guy, and I will show you like all the data. We have pieces that we've wrote on it actually on our website. Like, look, if the professional guys are having a difficult time with doing it, it's hard to say the guy that reads a snippet on Yahoo Finance is going to be able to like outsmart the institutions, right? Right. Because when you buy a stock, also it's not coming out of thin air. You're buying it from somebody else, basically, right? And usually that somebody else is like an institution. So they're like, for whatever reason, we don't like the stock, so we'll sell it to you at this price, basically, right? So you have to have a competitive advantage of knowledge in that case, of like knowing more than that institution or the guy that's selling you the stock. And that's what's going to give you this alpha or this return above and beyond what the market's going to give you in the long run. Okay. Yeah. Okay. I'm sorry I was long-winded, but
no, that's helpful, because I feel like people are like, well, because in my head, I'm like, well, I'll just pick the stocks of the stuff I like and what I buy and use.
Yeah. So I love that, Jacalyn. That's awesome. So, clients will continue to harp and push me, and I'll say, well, look, the first place you want to start, if you really want to do it, like, we won't do it for you. Okay. So first of all, if you say like, go buy this, I'll be like, it's a lot cheaper for you to go open up an online account and do it yourself than having me do it, basically. So, but I go, look, if you really want to do it, then I would start with the things you buy, right? Like the things that, because you have like a natural gravitation to those things. Like, do you shop at Target all the time, right? Like, Target's listed on the exchange. You might like their customer service or whatever it is. So that's kind of the first hurdle, is like kind of, I mean, there's over 3,500 stocks, right? How do you screen it out? So the first step is like, well, let's just look at the things that we like or we consume, right? Because we tend to think if we like it, other people are probably going to like it, right?
Yeah.
So that's probably good for the business model. So start there and then do due diligence. Now, how you do the due diligence, that's a whole, 3-hour segment that I don't think we have time for. But that's a good starting place. But again, if I can talk you away from it, that's usually my first like impetus, is like, look, individual stock picking it's a rough game. Even if I get it right, I'll be the first to admit it could have been luck, right? Like, just the market, for whatever reason, people like this company and off you go, right? Like, a good example is like HP back in the day, was doing really well. And then their CEO had a sexual misconduct scandal, and like the stock price did really bad. But that's like not based on the fundamentals of the company. It's just like this luck thing that happened, right? And the stock price suffered because of it. So it's like there is an element of luck in the short run when you're investing in individual securities or even the market in general. But again, for me to say I can have more due diligence, I can have better models, I can forecast better than the PhDs at BlackRock and Fidelity. That's a tall order for me to, swallow, basically. I'm like, well, no, I don't think I can do that. And if I do make the right pick, I will say there was an element of luck, because again, I'm buying that stock from BlackRock or Fidelity, right? In general.
Yeah. Okay. That makes sense. That's all of the questions that I had for you. This was incredibly helpful, very insightful. So I really appreciate your time. Yes. Before we part, is there anything else that you want to share, either about yourself, your company, the services that you do, anything else that we want to cover, or maybe even just talking a little bit briefly about like why you love what you do? I mean, it's clear with your explanations today, the passion you have behind all of this stuff. So,
I appreciate it.
But yeah, any parting thoughts, anything that we didn't cover that you want to make sure you touch on today?
Yeah. So I was, I started my practice actually in Indiana, and we moved out here about 2 years ago in Colorado, because we were drawn to the mountains, I suppose, and the sunny skies, blue skies, outside of Indiana. So we're kind of, we're not restarting, because I withheld all of my clients that I developed in Indiana and Chicago, and they've all stuck with me. The pandemic was actually in an odd way okay for my practice, because everybody got used to Zoom calls like we're doing today, right? So it wasn't like we had to be super live. But the thing that kind of motivates me the most is like my retired clients. Like, we got them to retirement, they're enjoying retirement. I always say my best days are the days I don't get any calls. I don't get a whole lot of calls from my existing clients, because everybody knows that, there's a philosophy that we're doing. We've framed things the way they do, to accomplish their goals, so to say. But seeing them be able to like enjoy the fruits of their savings that they've done all their lives, right? Like 50, 40 years that they've saved and tried to do things diligently. And now they're in retirement. And I just had a client the other day that was like, hey, we're going to Hawaii. It's $13,000. Like me right now, I'd be like, I probably, don't want to spend $13,000 on a Hawaiian trip, but they're in a good position. And it's like, great for you. Go enjoy yourselves. They don't have to worry about money, so to say. They can just do the things they want to do. And that's really fun to see, right? Like, being able to see clients enjoy the fruits of their labor. And in fact, sometimes we're like, look, you should take out more money. Like you need to use more money, because but they've just like saved their entire life, right? They've kind of lived frugally, or they've lived within a budget for 40, 50 years. It's kind of hard for them to like enjoy the money, so to say, right?
Yeah.
But that's what kind of motivates me, is like trying to put the client in the best position, right? Like there is no optimal position. Okay. So sometimes there's this notion of, hey, I need the optimal case. But with every investment decision you make, with every type of investment product you buy, or where do I put the money, there's always like pros and cons to everything. And at the end of the day, you have to kind of evaluate the pros and cons of for example, putting the money in the 401k versus the pros and cons of putting it into an IRA or something like that, right? And so we're going to try and help you with that if we can. But as a general investor, you always want to kind of be aware of where things can go wrong, because when things go wrong, that's where you get into trouble as far as successful investing in the long run, right? And so we try and do as much due diligence as we can. We're independent, so we're not like, we don't have to push one line of product or anything like that. We have access to pretty much everything under the sun. So we'll look at the client's situation and say, okay, well, based on this, usually I'll give them like 2 options. And like, I'm a big T-chart guy, so I like T-charting, pros, like, if you choose this option, this is what's good, but there could be the possibility of this. If you choose this, this is what's good, but there could be the possibility of this happening. And now, Mr. and Mrs. Client, let's talk through what's going to be more comfortable for you in the long run, basically. Right. And some clients are like, look, I don't even want that much information. Just like, do it, right? Do what is best. Whereas I always grew up under the golden rule where it was like, treat others like you want to be treated. Right. And I feel like whenever I go to a professional or something like that, like, I would like to see the options. I don't want to just be, force fed something. Like the worst scenario is like when you go to the car mechanic, right? Like, and there's something wrong with the car and you go to the car mechanic and they're like, well, ABC is wrong. And I'm like, well, I'm not knowledgeable enough to even know what ABC is, right? Like, so if it's broken, fix it. But I don't know if that guy took me for a loop or not, basically, right? So we're always trying to, that's why we try and present the options to be like, well, you could do this, or you could do this, or you could do this. And now let's try and figure out what's going to be best for your situation. That's kind of my modus operandi, I guess you could say.
Yeah, I like it. Awesome. Well, again, I really appreciate your time today. It was incredibly helpful and insightful. We'll include all of your contact information after the interview. That way, if anybody wants to get in contact with you, they'll reach out to you. But again, just thank you for your time and your expertise today. I appreciate it.
I appreciate it. Thanks, Jacalyn.
My pleasure. Thank you.